Good afternoon and welcome to Real Wealth's 2023 Q3 housing update with me, Kathy Fettke, CEO of Grow Developments, our syndication company and co-founder of Real Wealth. And here we go. Thanks for joining us. I know people are coming on, but I'll just get started. Most of you probably already know, but we've got a lot of new members. So my life before real estate was in the news business. And when I got into real estate, I kind of got on the other side of the reporter side and onto the guest side, helping anchor people and news reporters understand and interpret headlines because it's been confusing for a long time. So I'm just going to go through this, looking at some of the headlines of the first half of 2023, and it's just amazing what has happened since then. But you remember, I'm sure, that bank failures, the Fed raising rates anyway in spite of bank failures, which was kind of causing those, with CNN coming out saying a recession is probably coming, everybody thinking that. There were very few who didn't. Then we had, of course, the chaos of the debt ceiling and then the degrading of the U.S. credit as a result of that, and then BRICS. So the first half of The first half of 2023 started out rough, and here we are in September, and it's such a different story, not something very many people could have imagined. The stock market, this is just this week, this is literally like today. Stock market rose after strong economic reports revived speculation the Fed will be able to engineer a soft landing, even if it keeps interest rates higher for longer, which is what they say they're doing. People who thought we'd be in a recession by now thought the Fed would lower rates as a result of that, and that is just not where we are. You can see here Bank of America also saying soft landing, no recession. Here's what consumers can expect. The latest economic data points to the possibility of a soft landing. So, a lot of these people have been wrong, but this is what they're saying now. So it feels better, right? It feels better. Also, another super unpredictable thing, home prices back up to their all-time highs when rates were at 2 or 3%. Hello, who saw that one coming? I predicted that prices would come down 7%, which in some markets they did. It was kind of across the board. Some markets, the real bubble ones like Boise and Austin and Phoenix probably went down much more than that. But there were areas that didn't go down at all, and in some cases actually saw prices go up. So on average, you can see here this August 2023 Mortgage Monitor, home prices hit new record highs in 60% of major markets as annual growth rate rises, boosting homeowner equity levels. Again, so many people thought we would be in a massive housing crash by now. I wasn't one of them. I thought we'd see a little decline, but despite overall outstanding mortgage debt surpassing $13 trillion for the first time ever, and that's probably because prices are higher, home price growth has also pushed homeowner equity levels back to within 3% of 2022 peaks. That's just crazy. Total mortgage holder equity topped $16 trillion in June, with tappable equity, the amount that could be accessed while retaining a 20% equity stake, $10 trillion. The housing market isn't in trouble. That's pretty phenomenal. So all of this happening when mortgage rates have gone up dramatically. You can see where they are today is really not that rare by any means. If anything, it's pretty average and maybe even below average. So, these are normal mortgage rates. We shouldn't be freaking out too much. But the reason people are is because of this. The change has been so dramatic. So a lot of people are just sort of getting used to it. And if you went back to, a year and a half ago when rates were at 2 or 3%, people couldn't fathom 5 or 6% rates. But now that we've been over 7 and close to 8, people are begging for 6%. So it's always perspective. It's just perspective. And, the idea of a 5% is like heaven, whereas just a few years ago, no one would have done that. So it's going to be an adjustment period, but really this is pretty normal where we're at. And we have, many of us, myself included, predicted that rates would actually be coming down at this point because inflation's been coming down and the opposite has been happening. So I just want to clarify a little bit of what that's about. All right, so the 10-year Treasury, I've said this many times, but the mortgage rates are more tied with the 10-year Treasury and the bond market versus what the Fed is doing. So the Fed is at 5.25%, 5.5%, but interest rates have been much higher than that on mortgages. Generally, over the years, the 30-year fixed rate mortgage in the US has been about 1.7% higher than the 10-year Treasury on average. So technically, based on history, we would actually be at a 5.9% mortgage rate, which is why I was predicting that to happen by the end of the year. So why are the spreads so much higher if we should normally technically be around 5.9%? Why are we in the sevens? What's going on? Again, it's tied to the bond market. So we do see inflation slowing, but it's still too high. And then this just came out this week. The August wholesale inflation rises 0.7%, hotter than expected, but core prices in check. And this really has more to do with energy, but nonetheless, it matters. And this last line here, initial jobless claims nudged up 220,000 for the week, but below the 225,000 estimate. So we're in a weird time where bad news is good news and good news is bad news. I've said this a lot. We're in opposite world. But when you're trying to get inflation down, then you don't want a hot economy, because when the economy's hot, people are making money, they've got jobs, businesses are doing well, and that creates an economy, right? People are spending money, and when there's money being spent, and then there's more inflation as people are spending money. So the idea is that the Fed wants to slow that down, and that usually results in jobless claims. So the jobless claims are things we really want to pay attention to, and it's just not at all near where the Fed wants it to be. And it's so sad and such an awful way to manage an economy, but that's what's going on. So the economy is running hot. And as I was saying, when there's so many jobs and the economy's hot, then you have inflation, and inflation in wage growth as well. So we have pretty high wage growth compared to historic numbers, and not where the Fed wants to see that. It's actually, the rate of inflation exceeded the growth of wages for the first time in April of 2021. But just this past August, inflation amounted to 3.7%, while wages grew by 5.3%. So not what the Fed wants to see. They don't want to see wage growth. I know, opposite world, we do, they don't. This is a new thing called the GDP Now model. And GDP, you have to wait a quarter for news on how the economy is going. And that's not great for people trying to manage the economy and decide whether to raise rates more or not. So the Atlanta Fed has come out with GDP Now, which is a running estimate. And wow, it's good, it's bad, depending on how you look at it. But with the Atlanta GDP Now estimate, GDP is way too hot. It's up there in the 4 or 5% range, whereas blue chip consensus is that it's been lower. So once again, just data showing that it's still strong out there. Shocking, not what a lot of people expected. Not what you see in chat rooms on YouTube, that's for sure. Okay, so annual job growth returning to normal levels. You can see here the average job growth, we're right in line with it. But a lot of this is what the Fed's been looking at when looking through the rear view mirror at job growth. And Logan Mohtashami from Housing Wire has said a lot of the robust job growth may just be a returning of jobs, which kind of makes sense when you look at it this way, because now we're getting back in line. So this is good news. Things are starting to normalize, but the bad news is the Fed looks in the rear view mirror. So hopefully they're not taking too much of that into account and more looking at the current situation, which, like I said, with GDP Now they are, but still looking strong out there. And job openings are on the decline. So this is good. This is good. There were 12 million job openings, and oh my gosh, when they started hiking rates, and it's come down, but still way above what we're used to. The labor shortage has been an issue, and some people say, there was so much money floating around that people didn't have to work. If you had a two married couple, maybe one got to stay home with the kids, which is wonderful. But we did start to see some of those people come back in, and that is part of what brought the job openings back down, because people are coming back in and taking those jobs. But we're not quite there yet. There's still the labor shortage. Change in job openings from peak by sector. You can see a lot of people, thought it's basically across the board. It's not just one sector. And here's the chart again of 8.8 million job openings. And what this means is that when you've got only 225,000 jobless claims, but there's 8 million job openings, you don't have a recession, that's for sure. You've got a strong economy where the person who lost their job can turn around and get another one. Again, all good things, unless you don't want the Fed to raise rates again. So this has been a shocking past 18 months or so of rate hikes from the Fed. This affects short-term rates, commercial loans that are on adjustable rates, construction loans on adjustable rates. It's affecting a lot of industries. And it's been a huge shock to go from almost 0% to 6%, and then add the spread. There's a lot of adjustable rates that are 8-9%, even above that. On our credit line that we're not using because it's too high, it's like 9 or 10%, because they have to, it's adjustable. So they take this and their spread, and yikes. So that's why people don't want more rate hikes. But the Fed has said they were going to do 2 more. So there's probably another one coming in November. There's a consensus on that. Logan Mohtashami made a great point about this on Housing Wire, that, like I said, we should be between 158, 159 million jobs. Today we're at 156. So he really thought a lot of this robust job growth is just a return from COVID, and hopefully the Fed will see it that way. And again, jobless claims. This is a really important metric to look at, because as long as jobless claims are low, the Fed is going to be unhappy and want to continue to raise rates, because they see it as the problem, all this wage growth and all these job openings. So we got to pay close attention. And until these rise, we're kind of stuck here. And that leaves a lot of uncertainty in the market. A lot of us think it's this bubble, this tsunami of money that's just still circulating. When you make that much money, and $7 trillion, the amount of money in total that was in circulation in 2007 is what was created in a matter of 18 months, an entire economy. And when that was distributed, people have cash. A lot of people maybe bought stuff. They bought a house all cash. They can sell that house all cash. It's not like that just gets sucked out of the economy overnight, though they're trying to. And that's what this M2 is like the amount of money in circulation. And it's starting to go down, but not by very much. And so that money's still out there, and that may be a very good reason why things are still running hot. An interesting thing, I've probably talked about it on the last one, but baby boomers hold 50% of wealth, and there's only 24% of them. Now, you can get mad at them or just say, wow, they've been at it for 30 years and they've accumulated wealth over 30 years. Not all, but some. But with that, they do hold quite a lot of wealth, and as such, they are diving into the housing market. There is this was a headline just came out recently: baby boomers and their cash are driving the housing market right now. So this is why a lot of people are mad at them. But again, hopefully in 30 years, when you're old, you'll have a bunch of money too, and youngsters will be mad at you too. I don't know. But one of the things that Zonda Baby Chaser Index, this is cute, but it's basically that baby boomers like to be near their grandkids, and this is where they are moving as a result of that. Number one, just last year is Austin, then Raleigh, Orlando, Charlotte, Dallas, Nashville, Jacksonville, San Antonio, Atlanta, and Phoenix. So a lot of this baby boomer money is following their kids into these areas. 1/3 of home buyers paying cash. Like I said, there's a lot of cash out there, whether it's the boomers, whether it's just people who cashed in on those PPP loans, or or just did really well. I mean, people made tons of money in 2022. I know multifamily people who made millions. Somebody I know bought a multifamily property in 2021, sold it in 2022 for like 20 million more, something like that, to somebody who's probably lost all of that money now. But there were people there was a lot of money circulating, and that's what's still circulating, in my opinion. Plus, we have the lock-in effect of 73% of mortgages below 4%. I think 90% under 6%. So, people are not necessarily wanting to move. Also, people living in their homes today, the majority are locked into low payments. This is probably the biggest misnomer out there. This is the biggest confusion of people who are still on the housing crash bandwagon. They don't get this part. They're not looking at this slide. You are, so you are in the know. Homeowners are in the best shape they've been in for decades, based on their income, as we said, wages going up, and their payment is low. The lowest payment compared to their disposable income that we've seen in decades. So homeowners are not in distress. Who's in distress? Renters, because they don't have this. It's a very different scenario for them coming in today. But people in the market, it's like they jumped on the ship that's taken off, and they're doing fine. They're on the party bus, but people trying to get on that bus are having a tough time. So to think that there's a housing crash, you're looking at the wrong data. It couldn't be more opposite. New home sales. So because of the low rates, the low rates that people are locked into, they're not selling. Listings are down. That'll be on a slide. But because listings are down, new homes are what's for sale. So new homes are up 20%, the sales. And while existing home sales have been down 20% because there's just not much out there. So when you look at new home share of single family inventory, you can see it's just risen dramatically. And then the high end, the yellow line is the current market. 2019 is pre-pandemic. It's a great way to kind of compare. But you can see on high end today, high end is far higher than it was pre-pandemic. That has a lot to do with a lot of the money went to rich people. So, not a great pandemic plan, but that is pretty much what happened. Move up buyers also, though, current market much, much higher in most of these areas than pre-pandemic. Pretty fascinating. And entry level, not quite as different. And that might be because there's just not enough for them. There's just not the inventory. And new homes just can't be built cheap enough for entry level in most cases. Again, where boomers are moving, you can see active adult market compared to just the regular market. Lots of boomers moving to Austin, as I said, Orlando, Charlotte, either chasing their grandkids or just looking for a nice place to retire. But that kind of shows you where all this money's going. Okay, well, I said the baby boomers have a lot of wealth. What the millennials have is a lot of people, a lot of people right now. I've told you this a million times, but it's always cool to look at that bump. That bump is what's causing the problem of demand right now. Back in 2008, you can look at the orange section, that's Gen X, much, much smaller population, when there was about over 4 million homes on the market and a much tinier population. Fast forward to today, we've got a massive generation of people forming households, having babies, getting married, and a third or less of the inventory, maybe close to a fourth of what was available in 2008. So not the same market, don't compare. We have the opposite problem, no supply and huge demand. So this is, again, the 2023 housing theme, is this lack of inventory. I think possibly something the Fed didn't think about when they went through this process of raising rates. A lot of people can just incorrectly thought when you raise rates, you'll crash the housing market. You'll crash sales for sure, and that's what happened. There was a massive sales crash, the biggest one in history. But that doesn't mean it's a housing crash. It means that real estate agents are broke and mortgage brokers are broke, but there's just nothing for sale. It's just not trading. And that's what's happening. So inventory is just so low. The black line on the right slide shows, again, kind of where we're at, 510,000 in a market where you've got that big bubble of millennials. It's a real problem. It's a very, very serious and sad problem that as these people come of age, look at the difference in inventory just in 2015 when we were close to 1.2 million. Wouldn't that be nice to be there? But we're not. We are. It's sad how little is out there for this group of people that would really just like to start their family and have a place that's not on mom and dad's dime or in their living room. If anybody still, after all of this, thinks that there's a housing crash come, then maybe if you don't believe me, listen to this guy. He might know a little bit more than I do. Warren Buffett bets on the U.S. housing market with 3 new investments. Berkshire Hathaway put nearly $700 million into D.R. Horton shares for all the reasons I just told you. There's just not enough inventory and certainly not affordable inventory for the demand. So D.R. Horton tends to be a more affordable home builder in that kind of first-time home buyer range. It's still really expensive to buy a home, even for on the affordable end. But this should tell you something. Warren Buffett wouldn't invest in Lennar, which is a higher end, as he only put 17 million in that. But he wouldn't be putting any money in builder stocks if he thought that there was going to be increased inventory and a housing crash. A housing crash means that people can't pay their mortgage and they have to sell in a distressed situation. If that were what was happening, no one's going to invest in builder stocks and bring on new supply if there's going to be a bunch of supply coming. So that should give you a clue as to how serious this issue is of lack of inventory. What we do know is 18 million people are currently priced out of buying. Even a new home, not going to happen for them with 7% interest rates. You could see where the star is. A median price, new home price of $450,000 at 7%. You only have 26 million households who can afford that. 18 months ago, you had 44 million who could. So 18 million people priced out of the median new home. That's sad and tragic. So where are those people going to live? We know that owning versus renting for the past decade has been on par, kind of. Sometimes it was almost cheaper to own than rent. Then it would be cheaper to rent than own, but there were still enough benefits to owning that people would do it. But in the last 18 months, since rates went up, oh my goodness, really makes no sense for a lot of people to own when they can rent something for much, much less. So that is where we're at, is there's going to be a lot of demand for rentals. And that is also why we see single family rent growth as a result and a forecast of continued rent growth on single family. So you've probably seen this slide before, but I just want to remind people that in 2005 is when I started investing out of state with Rich. You could call this the top of the market. This is before, the Great Recession. It's when people started defaulting on their loans around 2006. It really picked up speed. And then, of course, the entire economy crashed in 2008. So you could say Rich and Kathy Fettke bought at the peak of these homes in Texas. However, when we went to Texas, we bought new homes because back then it was kind of a similar problem of, finding things to buy. There was so much competition. So we just went to builders and would, ask for any overflow that they had of inventory, which was very little. But I think, on this one, we paid $140,000. It might have been $145,000. It was considered retail. I think maybe we got a $5,000 discount or something like that. But I didn't care because I saw the opportunity and the fact that it cash flowed even paying full retail price. I knew what was coming to the area. I knew the growth, the infrastructure growth and so forth. So we did it anyway. And what we learned is that because that area had so much job growth, highest in the country, so much population growth, also the highest in the country, and the affordability, also the best in the country at the time. Obviously a house like that, $145,000, that was ridiculously affordable. with the rents being around 1,500. So with that combination, along with a fourth one, which is infrastructure growth, new freeways, new schools, new hospitals, new everything coming in to accommodate all the growth, which also boosts the economy, those properties did just fine. We had other ones that didn't in California, in Boise, but in Dallas, they didn't suffer at all. They stayed rented, rents went up, and there was never a time our tenants had any struggle at all in paying the rent. It was as if there wasn't a recession at all. And then over time, because of all that growth, there's only so much housing that can be built to keep up with massive job growth. So over time, this area in Rockwall, those homes have tripled, if not quadrupled, in price. So you get cash flow and growth, and you kind of are recession proof. Even if you buy a brand new home that's at retail, you could still make money and protect yourself from a recession. So making sure that your property's cash flow, it doesn't have to be a lot, but enough to cover your expenses. Cash reserves in hand. Don't over leverage. Just make sure you can make your payments. You've got enough cash reserves to do that. If there's if your tenant does lose their job and they have to leave, and you have the make ready costs and so forth, have to find a new tenant, you just need to have those reserves in place. Choose a fixed rate loan. And that will eliminate a lot of the stress of all these adjustable rates. As these rates go up, no one owning a home gives a darn about that because it doesn't affect them. Who does it affect? Anyone on adjustable. So commercial loans, multifamily loans that aren't on fixed rate. That's who's being affected. And of course, finding the right market, the market that is job friendly, that's landlord friendly, where if your tenant doesn't pay, you have the right to have them leave and bring in somebody who can. It's not your job as a real estate investor trying to feed your family to take care of someone who's lost their job. There are social programs for that, and a lot of these states understand that. So your job is to make sure your expenses are covered, and so being in the right market really matters a lot. Now, as soon as we heard that rates were going up, I was sitting next to our Dallas, Texas partner. You can go in to RealWealth.com to get her information. But as I've said before, it was just so obvious to us that we knew the demand was there. We knew people needed a place to live. We also knew they'd be priced out. So instead of freaking out about a housing crash, we thought we're going to be the only people out there buying stuff if we start a fund. So we did. We opened the North Dallas Rental Fund. We were accurate in that the demand has been insane for these rental properties, but we've had no competition in the acquisition side. So we've gotten unbelievable, far better than projected acquisition costs. In some cases, half of what we thought we would pay for a property. And the renovations are even coming in less because there's so fewer flips happening, because flips are harder to do when your flip loan is in the double digits, right? Those are adjustable rate mortgages and they're high. So when you can come in with cash, there's just really no competition. So this has been a really successful fund. It's closing out in November. If you want to know about it, go to growdevelopments.com. It's also why we're starting a build to rent fund for all the reasons I said. There's not the existing inventory, but there's a need for rentals. So we got to build them. And in this case, in the rental fund, we're buying properties that a first-time buyer could afford but wouldn't be able to get a loan on, because a bank isn't going to loan on a property that doesn't have a finished kitchen or has issues. They're not going to do that. So we can go in, buy them, fix them up, and put in that first-time future home buyer in there that's renting until rates come down. We're also very careful about where we invest, and these are in the Sherman area where a lot of reshoring is happening. Semiconductor business is being reshored with I think it was a $52 billion tax incentive or incentive from the Biden administration to bring those back from Taiwan and China. So we are buying these little homes all around these campuses where there's billions and billions of dollars going in. So again, it's just, there's so much opportunity out there. I want people to be excited to know that this is your time. This is not the time to be afraid. This is the time to get in before, as Barbara Corcoran says, before everybody else gets back in, as soon as they realize, oh, this is where we are, and the minute rates come down even a little bit, it'll be crazy. So this is your time to get in there. On the other hand, we do know that a lot of multifamily operators are in big trouble. They have price caps. Many of them bought these price caps because they had adjustable rates, and they bought insurance that if rates went up too high, that the insurance company would cover the difference. Well, a lot of those rate caps have to be renewed, and those insurance companies have lost their shirts, and so their rate caps are way up. Not to mention any multifamily or commercial real estate that has to be refinanced because their rates are adjustable, and at some point they have to refinance. In most cases, not all cases, they're in a world of hurt because the costs are so much higher. So again, here prices averaged 2.2 million in October, up from 200,000 a year earlier, and $45,000 they paid for these rate caps 2 years ago. So very sad. The commercial industry, commercial real estate, and anyone on adjustable rates is dealing with what 1 to 4 unit homeowners were dealing with in 2008, because most people back then were buying a home on adjustable rates. That changed with Dodd-Frank in 2012. Where almost everybody's on a fixed rate now, very few adjustable. Why would you go on an adjustable rate when you could have a low fixed rate? It made no sense. So unfortunately, it's commercial real estate hit by this problem this time, not the homeowner. And that's why if you're in a syndication where they're asking for capital calls, it's for this. They did not anticipate this, and many people didn't. Most economists did not anticipate rates would go up this high on the adjustable. So if you are looking to acquire assets in 2023, just you want to stress test for the best case, worst case scenario. I'm still seeing a lot of commercial deals, multifamily deals, where they're only looking at best case scenario. They're only looking at cap rates getting better, and it's really hard to imagine that with rates so high and probably staying high on the adjustable side. I think they really need to stress test for the worst case. A lot of the multifamily experts I know are not touching the market until the market has figured itself out. It doesn't know what it's, sellers still think that what they paid is what the property's worth, and buyers can't make the numbers work. So just be really careful and make sure you have a really good underwriter review the deal before you invest in it, because it's still very iffy out there. I'm sure there's great deals, just be careful. Review docs with an attorney so that you really understand it. High reserves in the pro forma. Make sure you've got plenty of reserves. That's always true, and a lot of times they don't. And then make sure that if they need more money, that they can't require you to do it in a capital call. That should be in the documents. Fixed rates at low LTVs. I mean, if they're assuming someone else's rate, that's great, but that loan most likely will come due, and so it will come due and have to refi into a higher rate. So the numbers have to make sense at that higher rate. Okay, so you probably already know this, but market data and referrals are at RealWealth, so you can get information on these different markets and why we're still so bullish on these areas. Rich and I just closed on a duplex in the Jacksonville area through our Jacksonville team. They were able to get us a 4.9% interest rate, because builders are in the business of selling real estate, and they can often negotiate lower mortgages. And we have a few of our teams that have been able to make that happen. So check that out for sure. Talk to your investment counselor. It's an incredible thing. All right. Let's go, and I'm going to look and see if I can look at these questions. Will this be recorded? Yes. I wish it was 7%. I'm in contract and my rate is 8.5%. Yeah, you gotta buy that rate down. Can you address the quality of new builds? I mean, they're new. It depends on the builder, right? If you have a you're gonna have a DR Horton that's going to be a little bit different than, like I said, a national builder. So each builder is different, but they usually have a builder warranty, which is great. And what's important to know about when you buy a new build is also what comes with it. I know I bought some new homes and didn't realize, oh my gosh, I've got to get blinds, I've got to get all the appliances, and it turned out to be 5,000 or 6,000 more than I expected. So make sure it's super clear what comes with it. And usually, it doesn't come with blinds, and you have to provide that for your tenant. So just, get clear on those things. I would also just do some research on the builder and what their reviews are. And what we've noticed, and it's not surprising because builders have had a really tough time, really, really, really tough time this past few years. Many of them are in adjustable rates. Many of them couldn't get the materials they needed with the supply chain issues. They couldn't even keep their sites open during COVID. They had to shut down. They've been through a lot. They couldn't get permits because the cities were shut down. So builders are in a world of hurt right now. One of the ways you could always protect yourself, and what we're doing with our new fund, our new build to rent fund, is we're not closing until it's done. We're not taking that builder risk. But if we are taking the builder risk, because we are probably going to do a few more syndications soon with Fred, many of you have invested with Fred. He's got a few more deals coming to us. And he's got 40 years experience, and he hasn't lost any investor money. And we've been working with him for 14 years. So, just knowing the builder, knowing the quality of their work will make a big difference. And if you're buying a new home, don't put too much money down. A lot of cases you could just put, $5,000 down and wait till the home's finished and then you close. If you're putting more money down, then you really do have to pay more attention to the build schedule. You need to understand their financials and so forth. How do you invest in the Texas fund? You go to growdevelopments.com, growdevelopments.com. That's my syndication company. I think you can also find it on RealWealth too. Charlotte new builds we looked at by a contractor who walked away because of poor quality. Who looked? I have not heard that. We've only heard, but you can always get an inspection, even on a new build. Make sure, and you can call around to other, like I said, look up the builder online, see what people say about them. Make sure there's a builder warranty, and after a year, if it's a year warranty, then if there's anything wrong with it, they're required to fix it. Of course, they have to still be in business to have that happen. So I don't know about the situation you're talking about with Charlotte. We've only heard good reviews. Maybe it's a different builder. It's so hard to get good property managers. What are you doing to vet your property managers? That is so true. Although it's gotten easier than when I started. When I started 20 years ago, it was worse. They didn't have the technology we have today. It was mom and pops, usually realtors, didn't know what they were doing. Most of them undependable, overworked. There are a lot of good ones, especially if they are part of a large franchise. Then they can tap into a lot more resources. Like, can't think of any right now, but they tend to be better. But it's a brutal job being a property manager, and they're not going to get 100%. But that is part of our process, is vetting them. And also part of being in a large network like ours. They don't want to lose our business. They don't want to upset our members. We will cut them off and send our people to a new property manager if they don't take care of our members. So it's definitely tough, but they do take care of us if they know that, there's that threat. or again, they're not on our list. So we have 20 questions on property managers you can find on our website, or just look at our network and consider some of the property managers we use. Which parts of DFW do you see the best price rent ratios? Well, when I started investing there, all of it was good. Now DFW, the Dallas-Fort Worth area, has gotten really expensive, and just the 14 or so, almost 20 years, sorry, wow, it's been a long time. The 20 years we've been there, prices have gone up drastically. So we just keep going out into the outer suburbs, because if you buy in DFW, you're only going to get the numbers to work in areas where you may not want to be, where there's high crime, where there's a lower chance of getting paid. So just be careful. Just because something's cheap doesn't mean it's going to perform. So we're just kind of moving out more into the outer suburbs, mostly north. But you can go on and speak with our team in Dallas. They're focused on the North Dallas area, and like we showed you, you could just go to the drop down or talk to your investment counselor at RealWealth. In your opinion, which syndication is the better choice, North Dallas or South Oklahoma? Wow, that's a big question. It depends on, I think they're both great. This is my best answer. In the Texas one, we're really buying a lot around Sherman, where there's some massive growth coming. So we've got some incredible acquisitions that you get to be a part of that have already been purchased. So you don't have to wait. That's kind of nice. Yeah, I mean, there is a waiting period to make it fair, but the acquisitions, a lot of them have already happened, and they're really good. They're older homes, but there's a lot of equity. But in the South Oklahoma, it's kind of the same distance. It just happens to be over the border, but it's because that part of Oklahoma kind of goes in, and it goes into where Texas would be on the other side. So it's not that much further to DFW than the North Texas fund, but they're new, and there's absolutely no housing. So we are excited about that. The appraisals have already come in much higher. There's a pref, and on the Oklahoma fund, we plan to refinance at some point and pay part of the capital back. So the pref and then paying the capital back makes Oklahoma really attractive while you're still getting the cash flow. North Dallas, we just got such inexpensive deals with so much equity that there's that, and in a really high growth area. So if it were me, I'd do a little bit of both, honestly. Okay. Do you have any funds that provide monthly distributions? Yes, the Oklahoma and the Texas one. We just closed our lending fund in Ohio. It would be great to get a drill down on stress testing, if not today, on a future session, key metrics, what to look for. That sounds good. I could have our underwriter go through it. That's a great idea for a webinar. How are you feeling about this new COVID warning from the CDC this fall? Do you think it will impact the market? Well, if it's anything like last time, COVID actually made real estate take off. People want more space. So all I can say is, based on history, COVID actually was good for housing. Weird to say that out loud, but I'm not worried about it, except for people's health. Although my daughter just had it, my son-in-law, and I think I might have too, and my grandson, and I don't know how bad it is, but I seem to know everybody who's had, a lot of people who have already had it. So it's out there, and I don't know, being sick is not anything new. Rents don't seem to be in line with the asking prices for both new builds and existing homes. What are your thoughts on this? It depends. It just depends. If you can negotiate a better rate, buy down the rate, have the builder buy down the rate like we did, and like a lot of our teams are offering, then it is in line. If you're in the right market, it still works. Also, it's really important to not put too much weight on year one of your acquisition, because it's literally the worst year for you to look at. Yet that's the only year that people look at. You're paying your closing costs. Your rents are where they are. They haven't gone up yet. So looking at your first year pro forma is a terrible way to build your future. What you really want to be doing is looking at a 10, 15, 20-year plan. How much do you think the rents are going to go up over time? How much do you think the value of the property is going to go up over time? Nobody knows, but based on some of the metrics I said, which is there job growth? Is there population growth? Can builders keep up? They can't keep up in a lot of these places. They're not keeping up in Dallas. There's a huge shortage. There's a shortage of homes everywhere. I think it's like estimated 6 million homes shortage. So you just got to look at the long run and ask why you're doing it. If you're looking to get cash flow today, it's definitely not as good as it used to be. But if you're looking to build wealth, there's still just tremendous opportunity simply due to supply and demand issues. Do you think subject to is a viable strategy? If I knew how to do it, heck yeah, it takes expertise and knowledge, but if I knew how, I'd be all over it. And I do know people who do it. So let us know if you want a referral. My property manager was sourced through RealWealth and they are quality. Oh, wonderful. Glad to hear that. Yes, the builder that we're doing another deal with is the same from Bozeman and Reno. What is the price range for rentals in the Dallas-Fort Worth area? That is too big of a question. There are multi-million-dollar homes and there are small homes, but the ones that we are doing in the fund, the rents are between, $1,000 and $1,300, but these are little $120,000 houses. If you're going to buy a new home, it's going to be, in the 200 range, so maybe around 1,600. But talk to our Dallas team because they own property management company, and they will be able to answer that question much better than me. Will the Dallas fund have depreciation benefits? Yes, it's a flow-through, pass-through entity, so that goes to the investors. And is there an idea of the return on capital? We're projecting an 8% per year return, but based on how things have gone, we think we will outperform that, but we can tell you we're certainly on track for that. Minimum investment is $50,000 in the fund. And again, you go to growdevelopments.com. Is there any legislation nationally being put forward to deal with squatters? Yeah, in California, you get to keep them. I think that's how the legislation works here. It depends, it just depends on where you are. And given our current administration, I would say it won't be in your favor. I'm just my guess, but that's why we choose the states that are more landlord friendly. Can syndicated investment be used as part of a 1031? I'm so sorry to say no. We don't have a DST. You can't exchange into a fund. You can absolutely work with one of our investment counselors and it will feel like you're in a fund because that's kind of one of the strengths. That's what we're known for at RealWealth, is helping take the stress off of you on a 1031. We don't, it's tough no matter what, but we have teams across the country who will make you a priority, and they have the exchange property. However, I would make sure, here's the ways you protect yourself in that: identify as many as you can so that in case some fall through, you're not stuck. Identify a DST so that if the appraisals come back or the inspections or whatever don't come back the way you want and you're out of luck time-wise, you could just do the DST. So just make sure you've got a backup plan, because sometimes people just identify one property and then it turns out to be not that great and they end up closing anyway, and then it ends up being a nightmare. So just have options so that you're not forced into closing on something. Okay. Do you plan to look into Austin and Las Vegas markets in the future? I really like Austin and really wish we could invest there. We haven't been able to make the numbers work, maybe in a build scenario, but so far it's just, I'd rather be in areas where the numbers work better, even though from a price appreciation standpoint, you can probably do better in Austin, or maybe that ship has sailed. I don't know. I know prices have come down. Las Vegas, same thing. I don't know, that the average income of the renter in Vegas is just not that high. So a lot of them are in the service industry, and I don't know. It didn't work for us, but I'm sure there are some great property managers and realtors that can help you in those areas. How can we find out about Fred's next deals? We're reviewing them right now, and we will have that out within a month, I think. I would say that the preferred return on those are they're between 10 and 12%. But it's a build thing, so you don't really get that till the end. So it's not a cash flow play. But as we have noted, there is a great need for housing, and this is the kind of market that Fred really rocks. We started in 2009 when he was just getting distressed deals left and right. We're kind of in that scenario again, and he's found some pretty cool things. One's an entitlement deal in Danville, California, and the other one is in Oregon. Thoughts on Denver? I'll tell you soon. My daughter's moving there and she's looking to buy. I know that prices soared. They're coming back down. You might be able to find deals, but it's a lot harder. How do you feel about the Oklahoma and Kansas markets? Do you feel they're comparable to Texas and Florida? Totally different markets. Oklahoma and Kansas are linear markets. Texas and Florida, Texas didn't used to be, but it is now, are growth markets. Oklahoma could become a growth market because there's talk of eliminating the state income tax like Texas, which would just make that area boom. Our Oklahoma project is just literally 10 minutes from Texas cities, so we were kind of considering it a Texas market, really. But there's also, like, if Oklahoma passes this, it is going to be phenomenal. Kansas has a lot of these non-growth markets have been growth markets when rates were at 2 and 3%. I don't know if that's going to continue. I still like those markets for cash flow and maybe appreciation, but they're not known for appreciation. So if you're looking to build wealth, you'd want to be in Texas and Florida. If you're looking for cash flow, it would be the more linear markets. I hope that helps with the chance of prices and values going up. But historically, it hasn't been the case. Are there any markets that come to mind in the Midwest that would be good to invest with the new factories, manufacturing plants coming online? Yeah, I mean, in Indianapolis, we have a great, wonderful, high integrity team there, and that's become a biotech center, and goodness knows that's been in the news. So, that's a growing area. Cleveland, we have a phenomenal team there. They have a huge health market, and we know that boomers are aging and they've got lots of money, and so that's important and valuable. Kansas, to talk to our investment counselors, they'll be able to give you more information, but absolutely, there is a lot of reshoring happening in those markets. And if you're going to come, if it's possible, I don't have a slide up, I don't think, for it, but we have a live event coming in LA. It would be worth it if you can to fly in, because all 10 teams will be there and you'll get firsthand information on what's happening in their markets. That's in right at the LAX airport. And you can find out more about that at realwealth.com. Landlord-friendly states such as Georgia are now a big issue. If you get a squatter in some nice suburbs of Atlanta, it takes 9 to 12 months to evict. Geez, I did not know that. Because the sheriff offices are overwhelmed and are currently working on 2021 evictions from COVID. Huge eviction backlog in some areas, and I'm living with it. I had no idea. I'm sorry to hear that. I have not heard it otherwise, and not from anyone else, but this is why we really need you guys as members to tell us what's going on, because we don't know unless you tell us. Never be afraid to tell us what's going on. We rely on your feedback, so please tell us. Should someone invest in a single family home or multifamily home first as a first-time home buyer in this economy? Single family, absolutely, for the reasons I said. Single family is solid. Commercial real estate is bumpy. I think there'll be phenomenal opportunity, but we just don't know when. Sellers are not coming down in price. So I would go, obviously, in the single family. Like I said, I think the opportunity is incredible. Somebody said the Indiana team is great. I had a good experience with them so far. They are wonderful. We love them. And you will get to meet them at our live event if you can. Okay, you guys, great questions as normal. We're going to start doing more Q&As because we know that there's so many questions out there and it's a interesting time. Again, just go to realwealth.com to learn more about our upcoming events and our webinars. You could talk to an investment counselor, and we should be having some more webinars on the funds. But if you go to growdevelopments.com and go onto the Invest Next page, where there'll be a lot of webinars that we've already done to teach you about those funds. But we'll have a few more live webinars coming up before they close. Okie dokie. And by the way, the Oklahoma one is a tiny raise, so that will fill up quickly. So if you're on the fence, I would kind of move quickly on that. Thanks, everybody. Oops, shoot, more questions came on Detroit. A lot of people are leaving Detroit. I think you could probably do fine, but we just decided to not focus on Detroit right now because the homes are so old and the CapEx is so high. It's just every time you have to fix something, it just wipes out your equity and your cash flow. So I don't know. We're just taking a break from Detroit, while at the same time, I know you can make money there for sure. If Texas eliminates the property tax, where will they get their tax revenue? They are so loaded right now. They have a surplus of money. So I don't think you have to worry too much. Okay. All right. Now we're finally done. Thank you, everyone. Have a great rest of your day. Bye-bye.